Hello dear students, welcome to our MBA program course, and our topic today is financial reporting. What is the purpose of financial reporting? When investors bring their money, hard earned money, saved, set aside, they keep in different avenues. It may be in post office, it may be in shares, it may be in banks for a compensation called interest. And if it is kept in the shares of joint stock companies, that's called dividend. So, by whatever name it may be called, it is the compensation for the sacrifice they are making of the financial resources and setting aside. So, when their hard earned money is kept aside and put it in the hands of the people, the custodian of their funds, they should be aware of where this money is going, how this money is spent. That is the whole purpose of financial reporting. The joint stock companies, in order to show to the equity shareholders about the financial performance of the organization, they have to disclose all that they are doing for 12 months span, that is 365 days or 1 year. It may be at times it is disclosed on quarterly basis or half yearly basis, but for yearly basis it is mandatory for every joint stock company. So, there are 4 quarters in a financial year. Quarterly you may present or disclose, or you may present annually. So, the objective of financial reporting, the very purpose of financial reporting is to communicate how their money, the investors' money is deployed and how that deployment gave the yield or result, and what is the percentage of the result. And it is your attaching the accountability on the custodians of your fund if you are the shareholders. It is not just that, the government also may put restrictions, or government also may require the custodians of the funds to maintain certain records. So, to comply with the government's regulations, one needs to maintain the data and furnish as and when it is required in order to present the performance, in order to comply with the regulatory requirements, and also to make decisions for the managers of the funds for future, maybe for the next year, for the next 5 years, next 10 years, next 20 years, how the company has to, the direction of the company depends on the decisions made now. And to make those decisions, one needs to have the financial data. So, in toto, we can conclude the purpose of financial reporting is to make decisions. Number 1, to comply with the regulatory requirements. Number 3, the how the assets are performing and what is the level of performance of the resources deployed in the organization. These are the 3 major reasons. Fine. The Indian financial reporting has evolved itself. If you look at in 1990s, it is the before 1990 it's a landmark year. Till 1990 we had a British accounting system, and also it is regulated as per the British accounting system. And by the time we have initiated the financial economic reforms with the prime ministership of the then Prime Minister Mr. P.V. Narasimha Rao and the then Finance Minister Dr. Manmohan Singh, there was a plethora of issues that were dealt with in 1991, and that is economic reforms. New economic policy it was called. The new economic policy, it is more than 30 years now. Okay. So, in the year 1991, we have migrated from British accounting system to to some newly set up standards, the modern accounting regulatory standards. And by the end of 99, that is post 2000s, there is a convergence of Indian accounting standards with the international financial reporting standards. By 2013, the erstwhile Companies Act 1956, which was modified or regulated or amended, it has taken a new shape in 2013. Now, to comply with the norms of 2013 regulatory, the Companies Act provisions, the new standards or some of the existing standards were modified or refined as per the new Companies Act 2013. So, this is the entire history. You can split the Indian financial reporting system, you can present in 4 phases. Phase 1 in 1990, phase 2 in 1992, and phase 3 2000, and phase 4 2013. And after 2013, there are little modifications made in 2016 also, but 2013 Companies Act amendment is historic, we can say. Right. Who are the key regulatory authorities when we are talking about financial reporting? It is the Ministry of Corporate Affairs. Ministry of Corporate Affairs is under the concerned minister at times, or it may be under the Prime Minister. Now, under this ministry, there are many institutions. You can say the Indian Institute of Corporate Affairs, that's newly set up. And in 1992, there was a regulator set up. Till then, till 1992, there was no regulator. Just in line with the Securities Exchange Commission in the United States, our Indian experts have discussed and debated, and they have come out with a new idea of setting up of another regulator even for India, that's called Securities Exchange Board of India. And this SEBI, Securities Exchange Board of India, regulates the operations of these stock markets and all other players, even the brokers, and that is to protect the interest of the investors in the country. So, this is another institution in addition to Indian Institute of Corporate Affairs. And likewise, we have Reserve Bank of India. Even before, the Reserve Bank of India was set up with the Reserve Bank of India Act in 1930s. The then, the drafting committee chairman and also was Dr. B.R. Ambedkar. He was also an economist. With his initiation, the Reserve Bank of India was set up in 1930s. Though it is set up in 1930s, previously it was called by other names, but now we are calling Imperial Bank. It might have been called, but today we are calling it Reserve Bank of India. So, Reserve Bank of India, after the formation, there was a Banking Regulation Act, BRA, in 1949. So, be it Reserve Bank of India, the central bank to the government of India, be it Securities Exchange Board of India, the SEBI, which is the regulator for regulating and protecting the interests of the investors in the country, or ICAI, the academic body also is there, Institute of Chartered Accountants of India. Now, this Institute of Chartered Accountants of India, it sets up these standards through another body within itself called Accounting Standards Board. And this ICAI or IICA or SEBI or RBI, they are all set up, they are all regulators for money markets and capital markets. If you look at the Reserve Bank of India, it is regulating the money market, but if you look at the SEBI, it regulates the capital market. Whatever it is, they are regulators set up with the proper enactment in the parliament. So, the policies are made in the parliament and that is implemented through these regulatory bodies. Now, let us look at the Indian accounting standards. As I told you, the accounting standards in India are framed by the Accounting Standards Board, which is part of the Institute of Chartered Accountants of India, ICAI. Now, let's look at the Indian accounting standards. They are modeled, they are styled after the International Financial Reporting Standards, IFRS. Okay, any company which is having a net worth of 250 crores and above have to maintain these standards, whatever standards are set in synchronization with the IFRS. They are supposed to follow these standards. For example, Indian Accounting Standard 16, it deals with the fixed assets like property, plant, equipment, and so forth. Now, let's look at Indian Accounting Standard 115. It deals with the revenues from contracts with the customers. So, these are the examples of the accounting standards. There are many accounting standards. We will not be able to present in detail all those things. You are advised to go through our material and feel free to contact us at any time on the given mail ID for the clarifications of the doubts. Now, let's look at the key components of the financial statements. Now, the balance sheet. Balance sheet, as we have spoken about, as we have discussed about in financial accounting, balance sheet is the one of the statements of accounts, just like your income statement, just like your profit and loss account and cash flow statement. You have balance sheet, you have profit and loss account, you have cash flow statement, you have net worth statement, and you have notes for all these statements. Now, every statement has a purpose for which it is prepared. Now, when it is balance sheet, to know the financial positions of the business organization. Just a recap from the previous session, to know the financial position in the sense the position of assets and liabilities of the company, we prepare the balance sheet. Okay, we also prepare another statement called income statement. If it is prepared on vertical format, it's called income statement, but if it is prepared in horizontal format, where the income is presented on the right side and the expenses are presented on the left side. The left side is, the left side is known as debit side and right side is known as the credit side. Okay. Now, if the incomes are presented at the top and the expenses followed by, and you will get a net result after deducting these expenses from the incomes, then you call it either profit or loss. But if you are presenting on the left side expenses and the incomes on the right side, and you will find, you take the total of these two sides, okay, the excess of the bigger total over the smaller total is a profit or loss. It is in the horizontal form. Fine, what for we prepare this income statement of profit and loss account? To know the result of the performance of the company for the last 3 months, if it is quarterly prepared. To know it for the last 6 months, if it is prepared half yearly. To know the performance of the company for 12 months or 1 year, if it is prepared for the year. The results are presented. The performance is presented in the profit and loss account. Therefore, informally, it is called as performance statement. Performance, how the money that is entrusted into the manager's hand has performed. Rather, they were experts in using that money that is entrusted into their hands, how best they could multiply the income. So, let's come to another statement called statement of cash flow or cash flow statement, where there are cash inflows and cash outflows. This is an annex to the balance sheet and profit and loss account. in addition to these three statements, you have detailed explanation given in the previous statements. They are called as notes to the financial statements. There are schedules in the balance sheets, there are schedules in the income statement if the accounts are prepared for a joint stock company in Indian setting, and each schedule is explained, and in those schedules also, if there are any doubts, if the accountants or the chief finance officer, if the chief executive officer feels that the investor may be perplexed in this particular area, if they think so, they will give the detailed explanation that's called notes to the financial statements. So these are the key components of the financial statements. Now, as I told you, 2013 is a historical year when it comes to the Ministry of Corporate Affairs, MCA, history or the annals or the chronicles, and this act resulted in a paradigm shift in the Companies Act and its provisions. Like what? It focuses more on the transparency and governance and accountability than just reporting and somebody comes and just checks it, examines it. It's more mandatory, more focus is given on CSR activities. What is that? CSR, corporate social responsibility. In a sense, 2% of the net profits for the given 3 years have to be spent on corporate social responsibilities, which means you should not be expecting anything in exchange to that spending. The hobby or the habit or the activity of business organization is, for every rupee that is spent, they expect a return. But when you are spending this 2% of your net earnings of 3 years, you should not be expecting anything in exchange. You should not indulge in any activity which generates revenue out of these resources. That means voluntarily and freely you have to spend these 2%. This voluntarily you have to spend these earnings, net earnings on the social activities, corporate social responsibility. And the Companies Act made it so strict that it should be implemented, executed in a strictest manner, and greater details of financials are also, they are also impacted in this 2013 Companies Act. Now, corporate governance, financial reporting in corporate governance, when you look at, when you say corporate governance, it is the ethics. It is the ethical way of doing business. It is not just making money, but making money in an ethical format or ethical manner. So, this 2013 Act ensures ethical business practice. It may be we have been till 2013 best practices of making business, but in 2013 the government made it very clear that there are best practices, there may be many best practices, but we want you to incorporate these ethical issues into your best practices. Okay, and there are corporate scandals. So we have seen in 2000s, early 2000s. One example can be Satyam debacle, Satyam Computers. When there was a manipulation in that company, the company stock was pricing earlier for 1600 rupees in the market. On the day when the company's the head announced the fraud, when he declared that this is the fraud, he himself, then the stock price has come down to as low as 4%. So these are the issues of ethics. So therefore, government has framed rules and regulations for ethical way of doing business and presenting the same to the respective stakeholders. Fine. There are certain emerging trends in reporting, sustainability reporting, and digital format, digitization. There's also called as forensic accounting. Now there's a need for forensic accounting due to fraudulent practices, that these accountants or people interested with the accounting job. So forensic accounting and digitization and ESG factors, economic and cultural, and governance issues, ESG, economic, social, and governance issues, ESG factors are also included in 2013 Act. Now, what are the challenges in financial reporting? Now, day by day, the accounting practice has become difficult because there are many issues coming into business transactions. All those transactions are to be recorded. When they are recorded, if they are inefficient, then huge amounts of shareholders' money is lost. If they are unethical, also huge amount of money is lost due to those unethical practices. Therefore, the reporting has become so challenging because of this kind of complexity, and corporate governance and fraud prevention has become a major challenge. Not just the ethical, not just the complexity, you also have to integrate with the international accounting bodies. Your reporting should be integrated with the IFRS. Why? Because all the companies, Indian companies are going global. Global companies are coming to Indian continent or Indian soil. When this migration is happening from other countries to India and from India to other countries, there should be synchronization, integration of the Indian practices of reporting with the international practices of reporting. Then time and again there's a big challenge, that is to get updated with the technological shifts in digital reporting. Now, once upon a time, the annual reports are printed and distributed in the AGM, and those who have not attended the AGM, annual general body meeting, and those annual reports are posted to the shareholders' residential address. But now, it is digitized. A soft copy is simply mailed to the shareholders. Okay, or it is posted on the website of the company, so that everybody, be it government, be it tax authorities, be it regulator, investor, employees, every stakeholder involved, interested in the affairs of the organization, can see those statements or reports, annual reports. So there's a shift in the technological reporting, that's a digital reporting. This is, I should say, my financial controller, our financial controller was not there for more than a month during the second half of the day. When I asked where is our financial controller, he's busy in taking classes. What classes? He is just getting acquainted. He might have done CA 30 years ago or 25 years ago. Now he has to get acquainted with the technical know-how of how to digitize this. Okay, so this is another challenge. One needs to comply with the digital requirement when it is prescribed by the regulator. Now, in conclusion, the Indian financial reporting is evolving with the global standards. We are not going standalone. We are not going on our own. We are advancing. We are adapting to all the new challenges. That's one area that we are complying with. We are also getting integrated with the international reporting community standards. So we are having you know a two-dimensional challenge. One is develop according to the changing scenario. Also integrate yourself with the rest of the globe or rest of the countries. So though challenges remain same and compliances, you still have another lurking fear called fraud. So you need to bear in mind the fraud, you need to bear in mind the compliance, you need to bear in mind economy, social and governance issues, you need to bear in mind the IFRS. All these things have to be kept in mind when you are reporting the financial statements or financial data to the respective departments, to the respective stakeholders. So with this, we are closing financial reporting 1, and there are special issues which we will talk about in our next session, that is special challenges or special issues in financial reporting. Now, in conclusion, in nutshell, I just want to bring you up what are the statements we are reporting for. We are reporting for balance sheet. We are reporting the balance sheet to the stakeholders. We are reporting income statement to the shareholders. We are reporting cash flow statement to the stakeholders or shareholders. And we are reporting the details of these 3 statements presented in our notes. A detailed explanation is given in notes. The notes information, the 3 statements information are presented to the shareholders and stakeholders. Stakeholders is a broader term where there are many parties interested to the company. Stakeholder means only those people who have invested money, stocks, or invested in the shares, stockholders. Okay, so stockholders or shareholders, stakeholders are everybody. It's a broader term. It's a broader term. So you are reporting to the shareholders and you are reporting to the stockholders, stakeholders. You are reporting to stakeholders, you are reporting to the shareholders. Thank you.